crop share, that is considered farm activities.
Okay, so that doesn't count as the 230.
Cash rent does not, crop share does. So crop share is Form 4835. For us, that would be, say an older person owns 120 acres, and we farm it for them. And we split expenses and income half and half. That's crop share, so 4835. Schedule E is just straight cash rent. For 120 acres, we give you $200 an acre. You're not really have much risk, that type of stuff, so you're Schedule E on that.
It's not subject to self-employment.
Right. And that's the biggest thing is Form 4835 and Schedule E, no SE tax. Schedule F and Schedule C, a little bit on K1s as far as partnerships, that type of stuff is SE taxable, but that's your main forms of SE tax.
So if you're a farmer, are you subject to the 230 and not qualified self-employment tax?
If you're a farmer, yeah, Schedule F. Yeah, if you're an active farmer.
So if you're renting the ground,
right,
and you're sharing the risk, you're on crop share, you still get by with the 230 for the income averaging and stuff. Okay. You don't have to make self-employment tax. If you're not the one out in the field. Okay. If you're the one owning the asset, you're not subject to self-employment tax.
Oh, and if you're the one in the field, you are.
Oh yeah. Okay. I always say I call it sweat. If you're on a W-2, if you're on a Schedule C, which is to be self-employed business, or if you're on a Schedule F, where you actually go out there and raise it or are in charge of raising it. If you hire somebody that custom hire your come in, fire your ground, stuff like this, but you're managing the operation, that's also subject to self-employment tax.
There was a question over here. Question. Does your company service other projects other than farming?
We do. Oh yeah, we do farming, individual trusts, estates, just regular corporations. A lot of businesses in town, that type of stuff.
Say if you're having a retreat, your business would be a retreat. Would you do something?
Are you for profit or for not for profit?
I'm trying to make up my mind now.
Oh, yeah.
Because I'm listening to you for the non-for-profit.
That money's got to go someplace. And you're going to hand it out to somebody else.
Now, is there anything saying in that non-for-profit that, like Red Cross and that type of stuff, they still have to do fees to have someone manage that? Is that a possibility in that?
But if you pay the fees out for managing it, that person who's ever getting those fees, that's taxable.
Right, but I think her thing is, if I want to do not-for-profit, but I also want to take some money. So if you do a W-2, that type of stuff, then you can still get the money to you. You can still get the money out.
But if there's any excess profit, you're going to have to give that money away. And that's what I was saying that before. That's a bigger tax than paying the tax.
Okay.
If you got to give $1 per dollar.
Yeah, we get some people that think that, say our tax due is $2,000, but now I can say we're doing forecasting and we're in the current year. Say our tax due is $2,000, but I can make charitable contributions of whatever it is to overcompensate for that $2,000. The way we always think about it is, if you're gonna do it, but don't think that it's dollar for dollar. I mean, if you're a 15% tax bracket, you're giving someone $1 to save 15 cents. Well, that doesn't make sense. Pay the tax. I mean, you're still 85 cents ahead. So don't think that charitable contributions and that type of stuff. If you want to do it, it's great. But don't think that you're actually saving money doing it. Let's go here first.
What is the excess profit? Because there are nonprofits that make profits like hospitals and everything else. So what is that number that's the excess profit?
Well, it's the profit above. Now, most of the time when you get into the bigger operations, they'll have reserves set up for down the line. They don't really make, if they're going to be truly not-for-profit, at the end they have to have at least a game plan. They might have a reserve for down the line, but they have to have an allocation. There has to be a place for that money other than going to the bottom line and going into the bank. There has to be an allocation. They have to be able to say, we're going to eventually give it to this, or we're going to use it for pro bono cases or something like this.
They have scholarships or something like that.
Exactly.
When you look at
they have to have a game plan. They can't just say, we're going to just bank our money and it's going to continue, but I'm a not-for-profit, so don't tax me. It doesn't work that way.
When you look at most hospitals, it's a small percentage that has to go to pro bono work. And then all the rest of the than the employees, and that's why they pay such high wages.
But
So
the
that
executives are paying taxes.
right, right. But to me, it would make a heck of a lot more sense to, if you're thinking about having something different, liability reasons, just set up a corporation. You know, for the non-for-profit stuff, you may save a little bit of money, but I mean, if you're still thinking of bringing money over to you, there really is no difference between having a non-for-profit with your individual or having a corporation with your individual. It just all depends on if you want to set up a non-for-profit and give some money away to someone else, that type of stuff. Yeah.
I got a stupid question.
There are no stupid questions.
Can you file two separate taxes? One for the farm and one for your other, or do you do it all together?
Well, it depends on if you're incorporated. If you have a farming corporation, then yes, it's a must that you got to file two separate tax returns between that corporation and your individual tax
Yeah,
return.
that's what I want to do.
Okay.
But everything that's connected with the farm is another separate,
Yeah, but the only thing that you run into is, again, the taxes could be higher doing that than, and again, like the lady said before, eventually if you want to get that money over to yourself personally where you can use it yourself, you're going to have to, the worst word that, if you have a C corporation, the worst word that you can hear is dividend. Because that's not deductible to the corporation and it's taxable to the other person. So that's the worst thing. So, you want to be sure that you know both ways, you know, what's going to happen. Because eventually you're going to want the money out of it.
right.
But that's why we would always recommend, if you're going to have a farming corporation, don't stick the land in, and then don't stick like major buildings and that type of stuff. We can get cheaper money coming across as rent than anything else.
And if you have a C corporation, and if you're the, I call it one more shop, where you're the only one in that, there's a lot of perks on the C corporation that's not available to the S. You can take life insurance off up to $50,000 term. You can have a
Long-term
retirement plan. You can have long-term care. You can have health insurance deductible at that level. You know, you can set up a HSA, health savings account. It's a wonderful thing that the employer can fund the whole thing, and if you're the only employee, you can go ahead and build up that bank account and deductible corporation, not taxable to you unless you use it for a non-medical deal. So that works, you know.
Okay, I got like they gave us all here a title to get my land. That is Omar's farm. So everything that goes to Omar's farm is by itself, but it's combined.
But
You're not actually incorporated. Just by giving yourself a name, like if you had a small business, that doesn't mean squat. Yeah, you actually got to be licensed with the state feds.
They actually get a separate EIN number, and so often they'll say Omar Farms DBA, which means doing business as, but you're still a self-employed person at that point. You haven't really changed title out of your personal name. You haven't really given it to another entity. And again, you want to be careful doing any of that, you know. You want to talk to an attorney, and people always say, I don't want to pay the attorney when I'm buying a house or something. I always say, if you got much money involved, always have somebody you can sue. And to be honest with you, if it screws up later on, you want to have, my daughter went and bought a house, and she wasn't going to hire an attorney, and I said, well, for $200, you're not going to hire an attorney. She said, why would I need one? I said, why wouldn't you, for $200, to have somebody that's something major asset like that, and have something screw up? Why would you want to take all the heat? Said, I screwed up. I wanted somebody said, hey, you screwed up. Now you're going to pay me because you made this for $200. Can you think of cheaper insurance? You know, myself, it would be a question, you know.
There was a question over here.
Didn't you have a question? Oh, what was your question?
Well, some parts of it was kind of answered. What you said about you have the EIN number?
The EIN. Mm-hmm.
So that puts the business separate from your personal.
Well, that doesn't necessarily. You got to be incorporated, then they give you an EIN. As an individual, you can also get an EIN, but that's only required if you actually hire some workers. Okay, so let's go through that a little slower. Okay, so once you incorporate, either to partnership, S Corp, C Corp, anything like that, they're going to give you a whole different number that tax return goes by.
EIN means employer identification number.
It's just like your Social Security number. It's It's identifying a number with a name, so then computers can take over from there. But like say you're on a Schedule C, so just on your individual return, say you have a small business. So even though you're not incorporated, you can still choose whether or not to have an EIN. But if you're still a Schedule C, so not incorporated, once you get one worker, you must have an EIN. Okay? So corporations, partnerships must have EINs. If you're on a Schedule C or a Schedule F, once you hire someone else, you must have an EIN.
Now, one thing that works real nice is they have LLCs, limited liability companies. If you're worried about the limited liability, a sole proprietor limited liability company doesn't need an EIN number because you can just file a Schedule C. It's very cheap, but you have a lawyer put that up in case somebody wants to sue you later on, you have some protection. Now, in that veil of liability protection has been pierced in over the years. It's not, but it's another hurdle they have to
You
get.
saying you're buying it? You're buying it?
No, I say you'd be a limited liability company. There's a veil of liability protection because you are a limited liability company.
They try to treat your, say, your personal home. If you're on a Schedule C and someone sues you, say for $10,000, and you don't have umbrella coverage in order to counteract that $10,000, they can come after all your personal assets. But don't be thinking that if someone sues you within a corporation, it's harder to do it, but they can jump over that hurdle and get to your personal assets as well. It's harder. It's a heck of a lot harder.
We never push partnerships too much because I say that's like getting married. You know, because what the partner screws up, that comes back to the girl. And so that's why we generally talk LLCs at that point, which can be a partnership or 1120S. And generally they're partnerships. If you have land to rent, LLCs work slicker than a whistle for renting out property because you have some liability if somebody falls in your rental unit or if somebody does something on your ground that they can sue you at least you have a hurdle for them to jump over before it gets done to you.
What do you recommend, I got two questions. What do you recommend for people who are farm businesses? I guess, well, that's an insurance, I guess, kind of question. And we have like farm tours or ag tours where people are coming to the farm and just to mitigate any kind of fall on the farm.
That's your screw-up insurance. That's your liability protection.
That's
your umbrella.
Yeah. The second question I had was with Social Security income. People who have, they're relying on Social Security income, but they want to be farmers. Do they get a corporation? Will that interfere with what they're bringing in Social Security-wise?
Well, no. You're just paying in, so it'd be similar to the people that are already drawing Social Security.
Yes.
Well, you can still be paying into Social Security benefits and get a little bit of that back. But as far as does that interfere with
drawing their Social Security? So, when you're a farmer, you're going to get so much income coming in, hopefully, from your farm business. Is there a certain amount of income that you can receive from that farm business without interfering with your Social Security?
Well, once you get over 66, so full retirement age, they don't care what the heck you make. You're going to get what you get. Now, say you start drawing early at 62, between 62 and 66, there are phase-outs on, I think it's right around the first 15,000. You can make under $15,480 for 2013. And if you're drawing Social Security, they don't care. But once you get over that 15,480, they start to phase what you're getting off of Social Security back. But once you reach 66, full retirement age, you can make whatever. You can make 80, 90,000 and still be paying in a little bit, plus getting all your benefits. They're not going to phase you out.
The downside is some of your Social Security, when you get that kind of income, will start being taxable. Now, you take half of your Social Security out to the rest of your income. If that number cracks over 32,000, and half the amount over 32,000 or half the Social Security is taxable, you get over 46,000. 85% of your Social Security, 85% of the worst Social Security can be taxed because that's not 85% tax. 85%, say you get $20,000, 17,000 of that is the most that will be added to your taxable income.
Okay.
And the reason why that 15% isn't in there is because you would have contributed that much to start with. Each one's paying the 7.6. 765. That gets you close to where you're only paying on the money above and beyond what was contributed in, so they're not taxing a tax.
So it's a domino effect. Once you start drawing Social Security and you got enough other income, either through W-2s, pensions, IRAs, rental, that type of stuff. Once you get other income, it's a domino. You have more of this become taxed. You got a domino that happens that you're not expecting, or your Social Security becomes taxed now too. So when you're taking out Social Security, don't think that it's all tax free.
And once you get into that 85% taxable, you might be in a 15% tax bracket because if Social Security is taxable, you're actually paying for every dollar of extra income, you're actually paying 28 cents on the dollar because of the Social Security being taxable in addition to the money that you're contributing.
And that's where planning is so important because people will come in, well, heck, I only made $40,000. Yeah, but you're drawing Social Security now. We got another thing now that's being taxed.
Okay, you mentioned that pension. Is the pension the same way?
As far as
Social Security.
Oh yeah, as your income goes up, regardless of whether it's earned income or non-earned income, you get above $32,000 after Social Security added to the rest of your income. And then you start paying, some of your Social Security is going to be taxable.
you could have a huge net on a stock sale, and that may force Social Security to become taxable to you. You could have interest income in a bank. Some of that may force.
Okay, I'm not even speaking about Social Security. I'm just speaking if you get a pension. Same way.
Pension is taxable regardless of the federal, but not in the state of Illinois. Neither is IRAs, neither is taxable Social Security. Now, the state of Illinois is one of the best states around for people that are retired.
Okay.
Because they don't tax any retirement income. Now, an annuity, if you buy an annuity and it's not part of a retirement system, the straight annuity is taxable income to the state of Illinois.
Social Security is a whole different animal than pensions or IRAs. Pensions automatically are taxable. It's just other income forces Social Security to become taxable to you. Pensions, it doesn't matter.
Question, I have two questions. Regarding the question she asked regarding pensions and things, you're saying that it is taxable?
Well, pensions, for federal, definitely.
But your state people is not.
Your state of Illinois pension, definitely. No, it's taxable to the Fed.
But you might be down low enough in income that you don't have to pay tax. Again, remember the $20,000 we talked about when two people married and they're both over 65, we can make up to around $22,400, something like that, before we start paying tax. So if your pension's below that, you still don't owe income tax at that point. But it is taxable income. Just because it's taxed, and that's why I tell people about IRAs. It's taxed, you take a traditional IRA and you take it out and you say, well, that's taxable income at that point. If you have enough to pay tax on. But if you're not over that $22,400, you're not going to pay tax on it regardless. So that's the difference on your pension.
That's why we look at line 43. We couldn't care less about what all the other lines said. We look at line 43, that means taxable income. We have a lot of retirees that it's zero for taxable income. Well, that means you have no tax. So you could have a pension, are you over 65?
Yes.
So, what do we got, 7,600 plus?
That's 39, maybe 11,500.
11,500. You can have, if you're a single person over 65, we can have up to $11,500 of just income. And because of the exemption and your standard deduction, that'll wipe all that income out from being taxed. But it's still
If you're
excessive.
over the 11,500, and you're required to file income tax, and if you're over 11,500, unless you've got a lot of medical expenses or church and charity, something to knock dollars down, you have a tax liability at that point. If you haven't been filed, well, number one, they would have caught you by now. But, I mean, not very long. About 2 years, they're usually about 2 years behind, but they would have caught you by now. They get, always remember, they get copies of those squeal sheets. And it just takes a computer just to run that figure. If that's over 11,500, they're going to send you a notice and how come we haven't had a report from you? Because even though you don't owe any tax, say your church and charity stuff's high enough that you don't have any tax on it, you got to prove it to them.
Yeah, I go through the process of, really, I come to IRS, let them figure it out for me. And they give me the figures. For any money, Social Security is the only one. I'm a state employees, really, I don't pay any tax on pension, but.
Not on the state of Illinois, you don't.
No.
Yeah.
But then Social Security is prorated depending on what's on the top of the form, your interest and your, lease.
But again, the state of Illinois doesn't tax either one of those types of income.
Sorry, yeah.
Yeah,
So it's prorated.
yeah.
One other question about the crop insurance. You guys cover that or some of it?
Yes, no.
Some-
Well,
Crop
they probably know something
Crop
about it.
insurance actually, the year that, it
I don't know about
depends on the year that you have the failure. The year that you have the failure, you get paid for crop insurance. Never worry, they'll always ask you, do you want it this year or you want it next year? And always take it this year, because you have a right, if you normally market your crop the following year, you have a right to shove that back one more year. In other words, you can shove that liability, there's a way you can defer that till the following year. So the money that you receive from it is taxable income, but as far as paying tax on it, as long as you normally marketed the crop the following year after you raised it, you can defer paying tax on that until the following year.
For example, like State Farm or something with an umbrella, can they add crop insurance or something? Have got that?
It's liability.
Liability.
Insurance.
Yeah, I mean, in case say for example, I invest $20,000 and I want to try to make maybe 20,000 net profit. So my crop insurance would be how much? How much $1,000 they normally charge?
I don't understand.
You know?
What's the question?
Well, we deal with grain crop insurance a little bit more than vegetables. On grain crop insurance, they look at your past years of yield. And then, like, we have 80% coverage. So say our yield was 100 bushel on beans.
Yeah.
Which, then say we had a drought year, they would cover us up to 80 bushel beans. But that actual payment then would be taxable to us. Because it's just in lieu, they don't care whether you actually grew that crop, you still got the money. So, but if you're just talking liability insurance.
Liability, yeah. In case the stuff don't come up, I invest in $10,000.
Well, that would actually be crop insurance.
That's crop insurance. That's not liability, that's crop insurance. And then, see, they have two factors in crop insurance. Either they have a replant part of it, and then they have, the replant is not deferrable. But if you have a crop loss at the end of the season, then that's deferrable.
So, if you have a crop loss, you got insurance, so you can't file a claim, so that doesn't get the money they pay you for the estimated value of the crop.
They estimate what, depending on what the coverage you have, and then what that dollar per bushel, that they figure out how much you want. They'll send you a check for that.
And really on vegetables, it's hard to conceive
I don't know
that
if they have crop insurance.
that would be,
They don't cover everything, So, but if it's in corn and beans, I know that they have crop insurance for that.
Is it very expensive in corn and beans?
it just depends on your coverage.
Yeah, they have some of it where it gets up to $50 an acre. But what we buy is generally the cheaper stuff. We usually buy between $12 to $15 an acre.
And now, then we got other guys that are heavily loaned money by the bank, and the bank forces them to have the highest coverage so they get the money back. So in that case, what's the highest you
About
ever
$50 an acre.
$50 an acre. I mean, that's a heck of a
They're
number.
taking a guy that borrowed money, so I mean, he's strapped a little bit to start with, and then they sort of kick him a little harder because they said, no, because they want to be sure they get their money back. And so, but then you got to pay that $50. Now, if you don't have a short crop, that money is out the window, basically.
Yeah,
But
like
the premium's deductible. Is that?
Like last year, when we had sort of record crops down by us, and it sounded like out here as well. I mean, that $50 that you paid into that's wasted that way. You can deduct it, but like we were saying before, deducting that is a small
If you
percentage.
take $1,000 acre farmer, that's $50,000. That's a lot of money in my case.
Yeah.
50,000 they could have gone around. Yeah.
Yeah. That's a conversion to a not-for-profit.
Yeah.
Going back to are you a farmer or not, in talking about the farm number, if your farm doesn't have a number, but you're doing 2/3 of your income, are you a farmer or not a farmer?
Now, a number meaning an EIN or a number with the FSA?
FSA.
with the FSA, you can talk
Well,
about it.
the FSA, that doesn't affect whether you're a farmer or not. They go by 2/3 of gross income. And 2/3 of gross income, we have people that don't participate in any federal government programs. They don't have a farm number per se. You know, that does not include you from the 2/3 of gross income. They look at the gross income. And actually, you know, and say this year, 2/3 of your gross income, you meet this quality, they actually have a little kicker in there that says, say the following year you had a real low income off the farming, as long as you qualified for the year before, they give you a 1-year carryover.
Which can be good and bad at the same time. Yeah.
Did I hear correctly that if you file your taxes and you have zero income tax, you don't owe income tax, but you still have a business on the side, you still have to pay SE tax?
SE tax, see, they base the SE taxes on whatever the business nets. So if you take that and you don't have enough to get over with your standard deduction, your personal exemptions, you have no income tax, you still have to pay the self-employment tax. That's right.
See, I should have an example of a 1040. It makes a heck of a lot of sense when you're looking at it. Because we've had some people that made profits on the farm, but they've had NOL from previous sort of group gathered up losses. And that loss wipes out their income tax. So they have on line 43, no taxable income, no tax. But SE tax doesn't care about that NOL. It all drives off that net off that farm. So you could have no tax and definitely still have SE tax on it.
Another thing, on IRA, if you take money out and you're not 59 and a half, don't meet any of the exemptions, there's a 10% penalty on taking that money out. Now, that penalty comes through regardless. Say you only took out, say, $6,000, you wouldn't owe any income tax. But you still have a $600 penalty on taking that money out because you didn't make any of the other.
Say you have no other income and you take $60 out of there early. You're still going to have to pay on $6.
Yeah.
Any other questions? We running dry? Yeah, that'll make it hard for us to answer it.
One other thing, the depreciation, when you talk about the depreciation again,
Okay.
you know, on the farm, how I got the question, how do you record rental of your property somewhere else and just get the money?
So we're looking at rental, so someone's paying you to rent your farm.
Yes.
Okay, so that's a Schedule E. So really all we can depreciate on land is possible tile underneath and buildings. Do you have any buildings on that? No? Okay. So really we'd be looking at tile improvements, possible buildings, grain bins that you would stick up. That we can depreciate. Normal land, that's a non-depreciable.
Ground is never depreciated.
Well, the first question, I guess I had it mixed up. The first question has to do with how do you record if you just rent land to someone else? How do you record that?
Well, number one, you charge them a fee. So we have the income. Then we have the real estate tax. If you owe money to the bank for that land, you would have mortgage interest on that. So that's a couple of things that we can take. Some auto and travel to check up on your land, to cash your checks into town or into the bank. We can take that travel.
Is it just like rental property? They have a list of things?
Yeah, most of the time our worksheets on that is just a Schedule E, and we just go line by line. Right? Right. So
for cash rent, they're paying you so much, you're not sharing in the crop, you're just getting charged so much per acre, right? Okay. I think just a Schedule E.
I mean, really, I think most of our expenses are usually, I guess,
Insurance.
Insurance, yeah.
Safe deposit box, you keep the deed in the safe deposit box deductible. Sometimes we even take a paper because they have a farm section that can't keep data journal. It will take the action. But it limits you a little bit.
but also you don't have the risk. It doesn't matter when they plant the corn, doesn't matter if they had the drought. And that's why they limit a lot of our, number one, you're not considered a farmer when you're a cash rent. Number two is, we don't get the special farmer rules then. So, but we don't have the risk. You get what you get, and it doesn't matter what the crop does. Right.
Can we take this last question?
Well, it's like back to Florida.
Back
I got my 6,000-pound truck, and I'm hauling equipment from one farm to another. That's 56 miles.
We do it for people that farm in Illinois and farm in Iowa, but we don't care whether it's Florida.
Okay.
Yeah.
Washington State, Colorado.
Yeah.
Probably their biggest question is going to be on that Florida stuff is, are you actually, you can be active participation, but are you actually managing the farm like that? I mean, on farms, you got to be, it's almost daily stuff. I mean, you can get a 6-inch rain and have to cut weed holes in there. If you're in Florida, you're not going to be able to do that.
Well, yeah, you may have.
Unless you stay for like 4 months and then go back.
We got partners and stuff.
Oh, yeah, I took turns.
As I said, no Daryl's anymore.
Well, everyone, I'm so glad that you all got a wealth of questions in. And I hope you got a wealth of knowledge out of it, too. So we're going to give them a round of applause. You all have business cards that you all can share. We have your name and information, your bio that you said, but I know I didn't put in your phone numbers or contact info on that sheet. If everyone can write it down, or if you have enough business cards.
I think we got possibly enough business.
Okay. They are local, so for the ones who are locally here, fantastic. Do you take people who are not local to the regional area?
We do them from New York City to California.
New York City to
I
California.
do them from my own store.
There you go.
I can slip on
So it doesn't matter where you are, you can have, they can
Yeah,
utilize their services.
You take long distance call from Florida.
You missed him.
On purpose. You did that.
Oh, but to be serious, we got plenty of Florida people.
Yeah.
They never come up here. We do so many things through email, through mail, and then we do phone interviews, just over the phone. So it's not like if you live somewhere else or you live up in Chicago, like it seems like most people. It's we have plenty of suburb people. Yeah.
So I can stand farm in the winter down there.
One of the beautiful things about, I said inviting the Hanson team in was because they have their wealth of knowledge of farming. A lot of accountants don't have a clue what to do or have that experience or even know what the first question to ask. They've probably seen it at Schedule F. So that's why you want to get someone on your team, your accounting team, business team that knows what you're talking about and has had the experience.
Most accountants will know the major stuff. It's really the ticky tack stuff that we catch more than other people. The small travel, like for your cash rent, I don't think I've ever seen any other accountant take like mileage to cash checks. But heck, if you didn't have that farm, you wouldn't be going over to the bank to cash checks. I mean, and subscriptions. Your biggest one is always subscriptions.
Well, the biggest thing, I try to fill out like I would fill out my own. And I say I try to whittle the tree, but I try not to kill it, And that's the idea, trying to always remember every dollar you deduct, you're saving 15 to 25 cents. Now, you can't make better money. We can deduct it, and it's legal. Everything that's right we take, everything that's great we take, and we try to stay out of the black. If it's wrong, it's wrong. That's just the way it is. If it's right, it's right. That's what we do.
Okay. All right. So everyone, thank you again for being very receptive of Hanson and Arlen and Andrew, and just making yourselves available to us is really a blessing and appreciation.
Appreciate you guys coming here. A lot